9 minutes to 8 on Morning Ireland, and Adam is back with more business news. Adam.
Thanks, Cathal. Over the past few years, the trend amongst property investors has been to target large retail assets such as shopping centres and retail parks rather than smaller shops. That appears to have shifted dramatically in recent months. According to real estate firm Savills, the third quarter saw a spike in the number of shops changing hands, particularly on the country's main high streets. And Dr. John McCartney, who's Director of Research at Savills Ireland, joins me now to discuss this. John, according to your figures, of the €530 million spent on commercial property in the third quarter, more than half of that was on shops, which is a big change from even a year ago. Why are we seeing that shift?
Well, absolutely. What we've seen really, I think, is that in the early stages of the recovery, investors could come in and buy prime city centre office blocks, which is, I suppose, the least risky commercial property investment you could possibly buy. And they could buy them at a very high yield of 8.5%. So the returns on the very best product were sufficiently good that you didn't really have to look elsewhere. But over the last 3 years, as the competition has heated up to buy these assets, the prices have been driven up and the returns have been squeezed, and as a result, investors have had to look further afield, and they've also had to look into other sectors of commercial property. And with the improvement in the consumer economy, retail is the next obvious target.
The sale of the sovereign portfolio was during that quarter that I mentioned, third quarter. That would have been a big chunk of these kind of shops. How influential has that been on it, and does that mean that in the next quarter it'll drop off again because that isn't having an influence?
Certainly. Well, we've seen gradually an uptick in the proportion of commercial investment that has gone to the retail sector, as we've said. But interestingly, very little of this money flew into the prime retail streets of Grafton Street, Henry Street, Mary Street, and so on. And the reason for that is that the assets that are held in those streets are really prime, top quality assets, and they, generally speaking, were held in non-distressed hands. They're owned by pension funds and investment funds and so forth, and they simply rarely come up for sale. So over the last 5 years, between the beginning of 2010 and the middle of 2015, we only had 8 shops traded on Grafton Street. We had a further small number traded in Henry Street, Mary Street. But because the sovereign portfolio was sold in Q3, we suddenly had 8 shops sold in these locations within 1 quarter. It's just the availability.
So you mentioned there Grafton Street, Henry Street, Mary Street in Dublin, a lot of activity there and a lot of money changing hands. Is it spreading beyond those key streets and more importantly into the main streets outside of Dublin and around the country? Well,
it's following the trend really in the consumer economy. One of the things that we've noticed in Dublin is that there has been this really pronounced pickup in population growth. Dublin's population now is currently growing at about 2.5% per annum, 32,000 extra people per year in Dublin. And when you've got more people out and about walking the streets, they need more stuff, and that shows up at the tills, and in turn that gives investors confidence to buy retail assets. Outside Dublin, the population is growing much more slowly, incomes are lower, unemployment is higher, and the ratio of shops to the population in some cases is quite high because of overbuilding during the boom. So it's taking longer for the increase in retail rents, let's say, to feed through, and as a result investors are at the moment most focused on the big cities. In saying that, it is gradually diffusing as the whole consumer economy picks up.
On a very different note, yesterday the government outlined its measures aimed at tackling the housing crisis. What's your reaction to what was contained? Are you happy with it?
Well, I think most of the focus has been on the extension of the rent review period to 2 years. We're not too excited about that. I think there will be some winners and some losers. If you're a sitting tenant and you've just done a rent review, then you'll be very happy because you're immunised against further rent increases for another 2 years. However, if you did your last rent review 18 months ago, you've only got 6 months of protection, so you'll benefit less. And unfortunately, really, I think the bottom line is that the costs and benefits are fairly randomly distributed. However, I think what's got less attention is the supply side measures that have been introduced. We've been calling for a number of years now for a reduction or indeed an elimination of development levies to reduce the costs of construction and get new projects on stream, because what we ultimately need to resolve the housing crisis is more houses to be built. And I think this is a very welcome step. The government announced a targeted rebate scheme for development levies yesterday, which will help to kickstart construction.
Dr. John McCartney of Savills Ireland, thank you very much.